Welcome back to Weekly. I'm chatting with Andrew Moffs of Vision Capital. Andrew, before the break, you were explaining how you don't like retail. You used to like retail, but you don't like retail now. You really like industrial. One sector I sense from talking to you a couple of years ago on Weekly that you liked then and you still like now is healthcare.
Yep.
Why do you still like healthcare, and what are your thoughts?
You know, the secret in real estate is thinking macro, top down, looking for themes, and then going bottom up. Where can you find the discounts? This has been a great theme in the market, the aging of the baby boomers. It's finally happening now. We see we see a scenario, an outlook where the supply cannot meet the demand that's going to hit this sector. And so you have to bifurcate the sector. We really like seniors housing, and we like it in both areas. The bifurcation being government pay and private pay. Nursing homes versus either independent living or assisted living retirement homes.
Okay.
Operators in that space, you know, on the skilled nursing side, Sienna Senior Living, great operator here in Ontario. They've actually been diversifying their portfolio a bit into the private pay arena, buying portfolios both in BC and Ontario in the retirement space.
When I look at that sector back 5-10 years ago, extended care used to be in the States, and I always remember that they would frequently miss the numbers because government pay in the United States was a terrible business to be in. Is government pay a better business in Canada than it historically has been in the States?
We believe so. First of all, it's all about demand and supply. And here's the supply picture. We face 30,000 residents, demand for 30,000 residents in Ontario. There aren't the beds to provide. That's the starting point. The second thing that we look at is basically you take no risk in this business, meaning that it's government funded. You either have to believe in the province of Ontario's credit rating or you don't. So a lot of REIT investors are very comfortable to take the credit rating of Canadian Tire or Loblaws and buy Choice REIT or buy a Canadian Tire REIT, yet they misprice the government of Ontario, essentially, when you look at the cap rate, implied cap rate of a name like Sienna.
So you obviously like Sienna. Where does Chartwell line up relative to Sienna?
Chartwell is a very good operator. We really like that company. They are a national operator of more of the private pay, the retirement side.
So Sienna's more government pay, Chartwell's more private pay.
Yep.
Sienna is mostly Ontario. Chartwell is more diversified geographically.
More diversified, but half their portfolio is coming from Ontario.
Right.
The reality is here in Canada, that we talk about the country of Canada, it's a handful of markets. You want to go where there's population growth, employment growth. In this case, you simply want to go where the demographics point you.
So you talked about valuation dispersion earlier on, and so when I think of what you've just said on seniors living, that is a structural growth story, as opposed to more cyclically oriented businesses. When you look at price to cash flow, cap rates, etc., what's the dispersion look like in the real estate space in general?
Well, it's quite wide, and even just sticking on seniors housing, you talked about 10 years ago. If you asked any analyst, hey, what's the cap rate on nursing homes? They tell you 10%. And we'd argue it's 7% and should be going lower. That's the opportunity. You go across sector by sector. We're seeing industrial cap rates. Great example today, Pure Industrial REIT is a subject of the takeover by Blackstone. Pure Industrial, that portfolio is trading at an implied cap rate of 4.8%.
Wow.
So this is a sector everyone loves. The stock was doing well. However, the analysts told you it was worth $6.40. We thought it was worth $7.50. And look, we were wrong. Blackstone came along.
What sectors are going the other way?
Where we have finally started to see cap rates go the other way is more in the secondary markets, whether it's in retail or office, more of that generic office space. You can just see there's tons of new supply, even here in Toronto. People want new space. People are using office space differently. That does not bode well for that generic, plain vanilla suburban office campus, for example.
And speaking of M&A, you, Andrew Moffs of Vision Capital, were very vocal in your demand that Pure Multi-Residential need to take that proposal by Electra America seriously, and they finally did. What's going to happen with Pure Multi?
Well, it's interesting. I mean, since our letter to the board that was released publicly, we've received overwhelming, unsolicited support. Unit holders agree with us. That is a very attractive price that's being offered, $7.59 cash for a portfolio.
US.
US dollars. that management themselves in their IFRS values were valuing much lower.
Right.
We believe it is a great starting point. It's a great price, great starting point. All we say is, a just say no tactic doesn't make a lot of sense here. Guide them. If this is the wrong price, sit down with them, negotiate. That's all we want, and that's the response we've received from other unit holders.
So what don't you like?
What we don't like, we've kind of touched on. We've avoided retail. In office, we do a lot of pair trades. We think there's great operators. However, the sentiment is pretty rough in that space.
And I know that you prefer U.S. versus Canadian companies in your portfolios at Vision at this point in time. Is that saying something about the political and economic environment in Canada, or is it saying something about valuation, or both?
Yeah, and to be clear, it's not that we like the United States over Canada. I mean, 40% of our portfolio is in Canada. We just see the growth opportunity going forward. It's all about job growth, employment trends. If you can paint a picture here in Canada that's going to be overwhelmingly positive, we'll gravitate more to the portfolio here. But at the moment, we see job growth higher in the United States at a time where the valuations, like I said, are very attractive.
And one last question before we go, Andrew. Here in Canada, one trend that I'm reading more about is urban densification. You bullish on that?
Absolutely. We talk a lot about net asset value. It's the hidden value in these companies that is not captured by analyst estimates. And what do I mean? It's going into a portfolio. We were at RioCan's Investor Day earlier this week. This is a company known for their retail shopping centers, power centers across Canada. They have a tremendous amount of infill density opportunities to go up and go vertical, build apartments. If you just simply put $150 per square foot on their entitlements today, you could easily add anywhere from $1 to $3 of NAV that's not captured anywhere.
Right, but that works in downtown Toronto,
Yes.
in downtown Montreal, in downtown Vancouver, but it doesn't work in Moose Jaw or Bowmanville, Ontario.
That's right. Demands for condos there, I have to suspect, are not as strong as they are here in downtown Toronto.
Thanks very much, Andrew.
Thank you.
I've been chatting North American real estate with Andrew Moffs of Vision Capital. Please stay tuned. After the break, I'll tell you what you need to watch for in the markets next week.